Welcome to Online Trading Campus and welcome to our OTC Futures course Module 2 Beginner. In Lesson 3, we will dive into futures contract symbols. In terms of the agenda of this lesson, I will be basically explaining how to plot futures charts correctly on your TradeStation platform, and therefore we have to understand terms such as contract specific, continuous contract and unadjusted continuous contract. And at the end, we will be putting everything together what we have learned in this lesson. So let's get started. Let's start with the contract specific symbols. Symbols are used to identify the particular product, the particular market, so to say, the contract month and the contract year. Symbols consist of three components. Component number one, market symbol, which is the symbol root on the TradeStation margin requirement website. This can be 1, 2, 4 letters, and in very rare cases the symbol also may include numbers. Component number two, the contract month, which is always a single letter. Component number three, the contract year, which is obviously a number. So if you want to trade the corn December contract in 2020, you would use CZ20 to plot this particular chart in TradeStation. So let's continue to look into the three components. Component number one, market symbol or symbol root, consists of 1 to 4 alphanumeric characters categorized the specific market. Crude oil is CL, gold is GC, S&P is ES, and so on. As I said, in rare cases, we can have numbers in the market symbol, like here on Mexican peso, which is MP1, or New Zealand dollar, which is NE1. Component 2, contract month. The contract month is categorized by one letter as per the below. January is F, February is G, March is H, April is J, May is K, June is M, July is N, August is Q, September is U, October is B, November is X, and December is Z. And by the way, there's no memory hook you can use to link a particular letter to its specific month. It's just something you should memorize over time. Component number three, contract year, is a number in the symbol determines the expiration year of the contract. 2020 is 20, 2021 is 21, 2022 is 22, 2023 is 23, and 2024 is 24. So now, futures markets are contracts being bought and sold that will all eventually expire. For example, the current S&P contract ESH20 will next be expiring on the 20th of March 2020. Before this contract expires, the majority of the daily volume and open interest will begin trading the next contract month, June. This is also referred to as a rollover. We will explore rollover in the next lesson. And by the way, volume and open interest we will also explore later on more in depth. But just for now, volume is the number of contracts created by a buyer and seller each trading session. And open interest is the number of outstanding contracts still not offset at the end of the regular trading session and carried over into the extended trading hours, basically carried over into the next trading day. Since each futures contract has an expiration, we could simply plot just the contract month that is trading and use that for our supply and demand zones. For example, you would enter the symbol for corn to be CZ20. That would plot the December 2020 corn contract. But there are some disadvantages to this. Eventually, the contract will expire and you will not have any more price action for that contract, nor will the exchanges accept orders for that expired contract. Moreover, a contract-specific chart cannot show all supply and demand zones accurately, especially when going back in time. The reason for that is very simple. Zones were created prior to the start of the life cycle of a specific contract month or when there was very low trading activity. As we can clearly see on these two chart examples, to the left CLN17, which is crude oil July 2017 contract, and to the right ECM17, a daily chart, which is the Euro June 2017 contract. On both charts, you cannot recognize candles to the left. Why? Because there were other contract months traded early in the year and years before that with more volume and more open interest. That's why we need a chart that will plot data that appears to have no contract expirations. These charts are called continuous charts. A continuous chart is designed to splice on the next month in the contract cycle once the volume leaves the front month contract. This allows you to see the price action of contracts that have good liquidity and full-bodied candle patterns, unlike a chart that is illiquid, causing you to see dots and dashes, making it very difficult to find good zones. The continuation charting style I would like to focus on is the unadjusted type. To get this type of chart, a trader using TradeStation must enter some additional numbers and letters after the future symbol root. These charts have no adjustments made to the price scale during contract rollovers. For us who create zones of demand and supply, these unadjusted charts reflect prices that a previous contract of a particular market actually traded at, thereby making zones more accurate. Usually there is a gap associated with these rollovers because of the different prices of each futures contract month. Sometimes the next month's price is higher and the gap is up. Other times the next month's price is lower and the gap will be down. These rollover gaps are treated just like traditional gaps and have a very high probability of being filled at some point in the future. Also topic for the next lesson. To obtain these unadjusted charts using TradeStation, we have to use a charting symbol that lets the chart software know when to discontinue plotting price data of an expiring futures contract and begin to plot the data of the new contract with the most trading volume, which is the front month. By the way, that's why we trade futures with TradeStation and only with TradeStation, because no other brokerage firm provides us a platform to plot unadjusted charts. All other brokers use adjusted charts. Adjusted charts distort reality. Gaps are removed by modifying historical prices. This modification of the chart is necessary for automated trading system. It allows smooth drawing, however it distorts reality. This symbol is not ideal for our way of trading markets. The way of creating these unadjusted charts is by using symbol-specific letters and numbers to let the software know when it is time for changing market data. A typical symbol might look like @ES equal 107XN. This is the unadjusted continuous chart for the S&P 500 futures, and this unadjusted continuous contract shows all supply and demand zones no matter how far they date back in time. So let me explain each component of the symbol. means continuous chart, ES is the symbol for the specific futures market, 1 means roll to the next contract month in the cycle, 07 means days, which is a rollover window until contract expires, X means until expiration, and N means unadjusted style. While this symbol will give the most accurate rollover dates to the TradeStation software, we have to calculate each futures contract to figure out how many days to use for days until expiration. While some futures share the same number of days, many do not. Whenever a futures contract rolls over from one contract month to the next, it is based on the volume of the two contracts. Once volume leaves the front month due to upcoming expiration, it usually goes to the next contract month in the cycle. Once this occurs, the month with the highest volume immediately becomes the new front month. It is at this point that traders need to begin trading the new front month. No matter what market we trade, until the market participants decide it is time to move the majority of the volume to another contract, then we stay put. Let me explain you briefly what these rollover days mean. These numbers tell the TradeStation charting software exactly how many days to roll over the futures contract near each expiration of the contract. Example, @HO equal 103XN. TradeStation software recognizes that an unadjusted continuous heating oil chart needs to be created. This chart includes automated rollover settings, in this case 03 trading days before contract expiration. Please note that we always need 2 digits including the 0. This allows for only prices to be plotted that contain the high volume of the new contract and discontinue plotting the contract that volume is going to be dropping off its expiration. What numbers do you use on each individual future symbol? So for the equity indices you use 0.7, for currencies you use 0.3, for interest rates you use 1.4, for metals you use 2.0, for live cattle you use 1.7, for lean hogs you use 0.9, for grains you use 1.0, for sugar you use 1.0, for coffee you use 2.0, for cocoa you use 2.0, for orange juice you use 0.8, for cotton you use 1.0, for crude oil you use 0.3, for heating oil you use 0.3, for gasoline you use 0.3, for natural gas you use 0.3, for DAX and Stocks 50 you use 0.1, and for Bund and Bobble you use 0.1. So, and how to calculate these numbers, I will explain in lesson 5 of this model. To cut a long story short, the unadjusted continuous chart shows all supply and demand zones no matter when they were created. We use this chart when planning our trades. Reason being, this chart has no interruption and mimics a contract with an endless life cycle. Now you can also see when we looked at the contract specific charts, we couldn't recognize the candles. Now using the unadjusted continuous chart on crude oil and euro, we can see all historic candles exactly how they were when they were created, and we can do our analysis. However, there's a catch to these charts. As a futures trader, it is important to know what the front month contract is. We will discuss that in the next lesson. But just quickly, the front month is the current contract closest to the expiration date. We usually trade the front month because of liquidity in the contract. We can determine this by finding the contract month with the most volume. As speculators, we need to trade in month with the highest volume to provide us better liquidity for both entering and exiting our trades. Also, the month with the most volume will create charts with better supply and demand zones simply because of more trading activity. TradeStation users will typically use a symbol like @S equals 110xn for their unadjusted continuous charts. This symbol tells the TradeStation software to create an unadjusted continuous chart for the soybean market that rolls over automatically 10 trading days before the contract expires. For many markets, this symbol works fine because every month that the exchange offers for that commodity is a high volume month. However, there are some commodity futures that have contract month listed by the exchange, but they do not have enough volume to become a front month. I will address which of these markets are impacted in a minute. One of these markets is the soybean market. Using the symbol @S equals 110xn has a flaw during the trading year. Soybean contracts are available for the following month each year to trade: January, March, May, July, August, September, and November. If a trader using TradeStation were to use the symbol @S equals 110xn, their charts would be putting the August soybean prices on their continuous charts. And once August expires, then it would be putting the September prices on their continuous charts. Just like a continuous chart is supposed to do. The problem is the volume for these contracts are very low, and the largest volume is now in the November soybean contract, making it the front month we should be trading in. So why does the exchange have a month listed for trading, but the volume is so low? Let me explain briefly. The soybean markets, as well as other grain markets, have something called old crop and new crop years. Old crop refers to grain that has harvested in the prior harvest season and kept in grain elevators to be sold during winter month and for a portion of the next growing season. New crop refers to the current year's harvest, which for soybeans will be completed by November. During the early winter month and late spring, the grain elevators storing these grains use the January, March, May and July contracts for hedging this old crop they have in their inventory. By the time August and September comes, most of the old crop has been hedged and the market is awaiting for the new crop for November delivery. Therefore, there's very little need or use for the August or September futures contracts usually. In 2014, the market was shocked by the USDA report, which is the United States Department of Agriculture, showing that last year's crop yielded about 44 bushels per acre, much higher than anticipated. When this report came out, grain elevators were more than happy to use the remaining old crop contracts to hedge with. But from the speculator standpoint, so from our standpoint, the largest volume remains in November soybeans, and that is where speculators should be trading. In the end, it is always about the commercials when it comes to trading futures. Once you have a better understanding of how they use futures contracts for hedging, you can see which contract month are their preferred choices. So to cut a long story short, how do we trade November soybeans on a continuous chart when the software is plotting the August prices? We must use a different type of future symbol to get the software to only plot the highest volume contract month on our charts. For our soybean example, we need to add some characters to the @s equal 110xn symbol. Once we add these symbols, you never have to change them because they are consistent year after year. The table to the right will provide a list of markets that need to have these symbol adjustments. Enter the symbols just like you see them, including all characters. For gold, you use @GC equals 120xn plus GJMQZ. For silver, you use @SI equals 120xn plus HKNZ. For corn, you use @C equals 110xn plus HKNZ. For wheat, you use @W equals 110xn plus HKNZ. And for soybeans, you use @S equals 110xn plus FHKNX. For soybean meal, you use @SM equals 110xn plus FHKNVZ. For soybean oil, you use @BO equals 110xn plus FHKNQVZ. For cotton, you use @CT equals 110xn plus HKNZ. For orange juice, you use @OJ equals 108xn plus FHKNX. For lean hogs, you use @LH equals 109xn plus GJMQVZ. And for live cattle, you use @LC equals 117xn plus GJMQVZ. I would like to address now how to set up your unadjusted continuous charts that only plot the most active trading month during the calendar year. Figure 1 is a chart of the gold market using the symbol @GC equals 120xn. The exchanges offer an October contract for delivery. There's very little volume and open interest in this particular month, but the software will plot these anyway. Look at the poor liquidity causing gaps and low quality candles. I used an old gold chart because I want to illustrate that once the upcoming August gold contract expires, we need to skip the October gold contract. To eliminate this problem, we need to adjust the symbol to chart only month that have the most volume and open interest. To see gold trading with the most active contract month, a trader using TradeStation should use the symbol @GC equals 120xn plus GJMQZ. Notice the letter V is missing from this list of the contract month. This tells TradeStation that when August gold nears expiration, then skip the October gold contract month and go directly to the December gold contract. Figure 2 to the right shows a chart of gold during the same time period as figure 1, but notice the difference in the quality of the candles and lack of gaps. Let's summarize this lesson by asking the ultimate question: which type of charts should I use? The confusion seems to come from whether we should use a contract-specific chart or a continuous chart to create our supply and demand zones from. In the unadjusted continuous chart, all contract-specific charts are linked together. The result is a never expiring chart/contract. The contract-specific chart does not show supply and demand zones which were created in the past because they were either created prior to the start of a new life cycle or when there was very little trading activity. However, you need to use it in order to tell the software on which contract you want to place an order. So our rules for that are very simple. For charting purposes, we always use the unadjusted continuous chart. For placing orders, we use the contract specific chart. So that's it for this lesson. In the next lesson, we focus specifically on the entire rollover process. So stay tuned for lesson 4 of module 2.